Hello, and welcome to the Commonwealth Market Update for February 2018. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. Well, one more time, markets had a great month. I could say I'm getting tired of saying this, but I'd be lying. I enjoy it. U.S. markets, all three indices were up at least 5%. International markets, both developed and emerging, again, were up at least 5%. We don't see months like this all that often, so let's enjoy it while we have it. We saw markets reach new highs. We saw markets continue to move up, but at the end of the month, we actually saw a bit of a pullback. So when we see that pullback, we have to ask ourselves a couple of questions. First of all, why did this happen? Second of all, is it likely to get worse? Well, let's start with why it happened. Because the flip side of the rising markets, the rising stock markets, was that interest rates also moved up. We saw rates move to levels we haven't seen in years. We saw them increase strongly. We saw them break through several what are called resistance levels that might have stopped them. So there's a real question, are we going to see rates continue to rise? And what would that mean? Well, first of all, we might see rates go up, but at the same time, there seems to be an indication that that's paused. And even if they do keep going up, as investors, we don't need to worry about that much. Fixed income, for example, that is to say bonds, took a bit of a hit on higher rates. But research we've done here at Commonwealth shows that even if you take a bit of a hit in the short run, the opportunity to reinvest at higher rates actually lets you make that up and even come out ahead in the long run. So as fixed income investors, we're not too worried about it. As stock investors, the reason that rates are rising really matters. And the reason rates are rising is economic growth continues to be strong. So stocks are perhaps suffering a bit from higher rates, but they're benefiting from faster growth. And at where we are in the cycle right now, historically, that's continued to be very good for stocks. And if you look at, in fact, the economic growth that we're seeing growth continue. We're seeing consumer confidence remain at very high levels, levels we haven't really seen in a decade or more. We're seeing business confidence, again, at very expansionary levels. Both consumers are spending strongly, business is investing strongly, and all of this is creating the kind of virtuous circle that should lead to continued growth. And that's only reinforced by the strong growth we're seeing around the world. This kind of a synchronized expansion can make things last longer and be stronger than would otherwise be the case, and that's exactly what we have here. Are there risks out there? Of course there are. The two big ones in my mind are the pending debt ceiling debate in D.C., again, one more time, and also North Korea. And both of those are looking like they're probably not going to be that bad. The debt ceiling debate could rattle markets, but at the same time, we saw this last month, and they cut a last-minute deal. That's certainly what we can expect this time. And North Korea, even though it remains an issue, is something that seems to have dropped back a little bit in the headlines. There's signs this might not be as bad as we thought. And that's a good thing. What will all this mean for markets? Well, it's probably positive, but as always, we don't know. But in any event, I will certainly talk to you next month, and we can talk about it then. Thanks for watching.